the US. Federal Reserve Fed plays a pivotal role in shaping the economic landscape through its monetary policy decisions. These decisions, particularly those related to interest rates, have far-reaching implications for the economy, affecting everything from inflation and employment to consumer spending and investment. Recently, the focus has been on the potential for interest rate cuts, following positive statements from Fed Chairman Jerome Powell and other members of the Federal Open Market Committee (FOMC). This article delves into these developments, exploring the statements made by Fed officials, the economic data influencing these discussions, and the broader implications for the U.S. economy. In recent remarks, Fed Chairman Jerome Powell provided an optimistic outlook on inflation, suggesting that the central bank is making progress in its efforts to curb rising prices. Powell's comments have led to increased speculation that the Fed may soon begin to cut interest rates, a move that would signal a shift from its current restrictive monetary policy. Powell's statements have fueled expectations that the first interest rate cut could come as early as September. This anticipation is rooted in the belief that the Fed is nearing its inflation targets and that economic conditions are becoming more conducive to a reduction in rates. However, these expectations are tempered by cautionary notes from other Fed officials, who emphasize the need for more data before making such a decision. John Williams, a prominent member of the FOMC, recently provided additional context to the Fed's thinking in an interview with the Wall Street Journal. Williams echoed Powell's optimism but highlighted that the Fed still requires more data to confirm that inflation is on a sustainable path toward the 2% target. Proximity to rate cuts. Williams stated that the Fed is getting close to a point where it could consider cutting interest rates. This suggests a growing confidence within the Fed that inflationary pressures are easing. But data dependency. Despite this optimism, Williams emphasized that there won't be enough data before the September meeting to definitively prove that inflation is on a sustainable downward trajectory. He stressed the importance of additional data to gain greater confidence in the trend toward the 2% target. Disinflationary trends. Williams noted that the data from the past 3 months, including June, indicate a movement toward the desired disinflationary trend. He expressed a desire to see more data to bolster confidence that inflation is moving sustainably toward the Fed's target. Timing of cuts. Williams ruled out the possibility of an interest rate cut in July, stating that the period between July and September would be critical for gathering the necessary data. He mentioned that the Fed would receive 2 months of inflation data during this period, which would provide valuable insights for the September decision. Challenges in achieving the 2% target. Addressing concerns about the difficulty of bringing inflation down to the 2% target, Williams expressed confidence that the Fed can achieve this goal. He pointed out that significant progress has already been made in reducing inflation from its peak levels. At its upcoming meeting on July 30th to 31st, the Fed is widely expected to keep interest rates constant within the range of 5.25–5.5%. This range has been maintained for a year as part of the Fed's strategy to manage inflation without stifling economic growth. The decision to hold rates steady aligns with the cautious approach advocated by Williams and other Fed officials, who emphasize the need for more data before making any changes. Powell's recent statements have had a noticeable impact on financial markets. Investors are increasingly pricing in the likelihood of a rate cut in September, reflecting growing optimism that the Fed will soon begin to ease its restrictive monetary policy. This shift in market sentiment is driven by the belief that inflationary pressures are subsiding and that economic conditions are improving. Economic data plays a crucial role in shaping the Fed's decisions on interest rates. Key indicators such as inflation rates, employment figures, and consumer spending trends provide valuable insights into the health of the economy and the effectiveness of monetary policy. In the context of recent discussions, several data points are particularly relevant. Inflation data. Inflation remains a central focus for the Fed. Recent data suggests that inflationary pressures are easing, with prices rising at a slower pace than in previous months. This trend is critical for the Fed as it assesses the need for rate cuts. Employment figures. Employment data provides insights into the labor market's health. Strong job growth and low unemployment rates are positive indicators, suggesting that the economy can absorb rate cuts without risking a significant slowdown. Consumer spending. Consumer spending is a key driver of economic growth. Recent data on consumer spending patterns indicate a healthy level of demand, which supports the case for easing monetary policy. To fully understand the implications of the Fed's potential rate cuts, it's important to consider the broader economic context. The U.S. economy has experienced significant challenges in recent years, including the COVID-19 pandemic, supply chain disruptions, and geopolitical tensions. These factors have contributed to volatility in financial markets and uncertainty in economic outlooks. Monetary policy is one of the primary tools used by central banks to manage inflation. By adjusting interest rates, the Fed can influence borrowing costs, consumer spending, and investment decisions. When inflation is high, the Fed typically raises interest rates to cool economic activity and reduce price pressures. Conversely, when inflation is low or the economy is slowing, the Fed may cut rates to stimulate growth. The Fed operates under a dual mandate to promote maximum employment and stable prices. Balancing these two objectives can be challenging, particularly in an environment of economic uncertainty. The recent discussions around interest rate cuts reflect the Fed's ongoing efforts to fulfill this mandate while navigating complex economic conditions. To provide a comprehensive analysis, it's useful to examine historical instances of Fed rate cuts and their impact on the economy. Past rate cuts have often been implemented in response to economic slowdowns, financial crises, or other significant disruptions. By reviewing these cases, we can gain insights into the potential outcomes of the Fed's current deliberations. Inflation expectations are a critical factor in the Fed's decision-making process. These expectations influence consumer and business behavior, shaping spending and investment decisions. If inflation expectations are well anchored, the Fed can be more confident in its ability to manage price stability. Recent data suggests that inflation expectations are becoming more stable, supporting the case for potential rate cuts. Effective communication is essential for the Fed as it navigates complex economic conditions. Clear and transparent communication helps manage market expectations and provides guidance to businesses and consumers. Powell and other Fed officials have emphasized the importance of data-driven decision-making and the need for a cautious approach, reinforcing their commitment to achieving the dual mandate. The Fed's monetary policy decisions have significant implications beyond the U.S. economy. As the world's largest economy, the U.S. influences global financial markets, trade, and investment flows. Interest rate cuts by the Fed can affect exchange rates, capital flows, and economic growth in other countries. It's important to consider these global implications when analyzing the potential impact of Fed rate cuts. The recent statements from Fed Chairman Jerome Powell and FOMC member John Williams have provided valuable insights into the central bank's thinking on inflation and interest rates. While there is growing optimism that the Fed may soon begin to cut rates, officials emphasize the need for more data to confirm that inflation is on a sustainable path toward the 2% target. The period between July and September will be critical for gathering this data and making informed decisions. As the Fed navigates these complex economic conditions, its commitment to data-driven decision-making and effective communication remains paramount. The potential for rate cuts reflects the Fed's efforts to balance its dual mandate of promoting maximum employment and stable prices, while also considering the broader economic and global implications of its actions. While the path to potential interest rate cuts is becoming clearer, the Fed's cautious approach underscores the importance of careful analysis and data-driven policy decisions. The coming months will be crucial in determining the course of U.S. monetary policy and its impact on the broader economy.